This Chapter 4 demo problem covers really everything that we will have studied in Chapter 1 through 4. So we're going to do it in components or parts. So Part 1 are regular journal entries throughout the month of June for this particular company. So let's go through and analyze these transactions and make journal entries. So we see Linda and Friends invested $30,000 cash in her yard service business and received common stock. So from the company's perspective, what did they receive? So the company received cash, and what did the company give up? Well, the company issued common stock. So we have of the give and take, cash came in and common stock was issued. Then, that's the give and take analysis. Then we go down to our horizontal model down here, assets equal liabilities plus stockholders' equity, recalling that there's two components of stockholders' equity, common stock and retained earnings. We know retained earnings goes up when we have net income. Net income is defined as revenue minus expenses. And then if earnings are distributed, those are dividends. So it reduces the earnings retained in the company. So this is the big horizontal model. So if we apply this up here into this model, we know that cash is an asset, it's going up, and we know that common stock is part of stockholders' equity, it's going up. So we keep the horizontal model in balance. That's the second step. Then the third step is to apply our debit credit rules. If we have an asset and it goes up, we assign that a debit. That's the case over here. If we have a liability or stockholders' equity and it is going up, we assign it a credit. So now we're ready to go to our journal. We will debit cash for the $30,000 and we will credit common stock. So let's turn the page and go do that. So our journal entry is to debit cash, which is an asset, for $30,000. And credit common stock, which is a component of stockholders' equity, for $30,000. And the debits go first, okay? So I list my debit first and then my credit. Okay, let's look at the second transaction. The company purchased 2 lawnmowers for $15,000. What did the company give up? The company gave up cash, right? They wrote a check, so our checking account balance will go down, so cash will go down. In exchange for the money or the cash, what did the company receive? Well, the company received lawnmowers. So that's the give and take exchange. The company received lawnmowers in exchange for cash. That's step 1 of the analysis. Then the second step is to put these into the horizontal model. Well, these are both assets. They both are things the company owns. So we've got cash going down, which is an asset, and we have lawnmowers going up. So we have an asset exchange, and nothing happens on the other side of this horizontal model. So we have cash being exchanged for a lawnmower. Okay, that's step 2, putting it into the horizontal model. Step 3 is assigning debits and credits. These are both asset accounts. Cash is an asset, lawnmower is an asset. So now I'm going to look to see if the asset goes up, it's a debit. So I'm going to be debiting lawnmowers, and if an asset goes down, it's a credit. So we will be crediting cash. So when we go to our journal entry, we're going to debit lawnmowers and credit cash. So let's turn our page and go do that. So I list the debit first, so lawnmowers. That's an asset. And I could have called it equipment. I didn't, but we could have called that equipment. It would have been fine. And then the credit is cash. And that's causing assets to go down. And that was $15,000 each, debit and credit. So our debits and credits equal. Transaction number 3. The company mowed yards and collected $1,000. So what did the company receive? Cash, right? Money. So they collected cash in exchange for what? They mowed yards. So they mowed yards. And we're going to have to think about, what is that? So the company mowed yards in exchange for cash. Well, the cash part is easy. We know that's an asset. So we know when we go down here, cash is an asset going up. Mowing the yard, what is that? Well, I have to go back and really clearly remember what's a revenue. Revenue is the action of providing goods and services. So that's when we're providing goods and services. And that's what this company is in business for, right? This company is in business to mow yards or provide yard service. So that is their main revenue. So this is a revenue, and we're increasing our revenue. So when we get down here, over here, we're going to have an increase to revenue. So this company mowed yards, that's their main revenue. That's what they do for business, is they mow yards, so that's revenue. So the company provided services, which is revenue, in exchange for cash. And that keeps this in balance. Okay, that's step 2. Now step 3. Cash is an asset, it's going up. So my debit credit rules tell me that's a debit. Over here, revenue is going up. Revenue increases retained earnings. So if it goes up, that's a credit. So I have a debit to cash and a credit to revenue. So let's go record that. So we're going to list the debit first. So we debit cash, which is an asset, for $1,000. And we credit, I'll call it service revenue. And that increases retained earnings or stockholders' equity, whichever abbreviation you want to use. So I use stockholders' equity here. You often see me in class use retained earnings. But it causes those to go up. So this side goes up and that side of the equation goes up. Okay, transaction number 4. Mowed 5 yards for $250 on account. Okay, so let's do the first part. The company mowed yards. And we know that's their main source of revenue. So they provided services, so we already know that's revenue. Because that's what they're in business for, to mow yards. So they've delivered their service. They've provided that. So they mowed yards, and in exchange, what did they receive? Well, it was on account. That tells me then they didn't get cash right away, that they have an account with their customer. So what they received in return is the customer promise to deliver us money in the future, or promise to pay us money in the future. That might be an easier phrasing. Promise to pay us money in the future. So the company will receive cash in the future, so that's why this is going to be an account receivable. So they mowed yards. In exchange, they received this accounts receivable, and that represents a right to receive cash in the future. That's an asset. And I'm just going to abbreviate it. So that asset is going up. We have more accounts receivable after this takes place. And when we put it down here, we also know this side will go up for the service revenue. So I put these down here, analyze it in terms of the horizontal model. Assets go up because we have more accounts receivable. Revenue's going up. Once I know that, I can go assign debits and credits. This increases assets. That will be a debit. Over here, revenue. Revenue increases stockholders' equity. That makes it a credit. So when I go to my journal, I will debit accounts receivable, credit revenue. So let's go write that down. We're going to debit accounts receivable. Which is an asset. And credit service revenue. which increases retained earnings, which is part of stockholders' equity. So it increases stockholders' equity or retained earnings, and that transaction was for $250. Transaction 5. The company received $300 from customers to mow for June and July. So what did the company receive? The company received cash. In exchange, the company is supposed to mow yards for June and July. But we haven't provided that service yet, so it's not revenue. Okay? We haven't earned the revenue yet because the company hasn't mowed the yards yet. They have an obligation to mow yards in June and July. That obligation is some sort of liability. So we get cash. In exchange, we promise to mow these yards for June and July. So that account is called unearned revenue. And again, it is a liability account. So in this transaction, cash is received. In exchange, we create a liability that represents an obligation to mow yards. So here we can see, cash goes up. We have liabilities going up for the unearned revenue. I'm just going to abbreviate unearned revenue. So I put it down here, and again, I just abbreviated that. Assign debits and credits. Cash is an asset. If assets go up, that's a debit. Over here, if liabilities go up, on this side goes up with a credit. So now I have my debit is to cash and the credit is to unearned revenue. So let's go record that. So we have a debit to cash and a credit to unearned revenue. And remember, unearned revenue is just an obligation to perform services. It's a liability. And that transaction was for $300. Transaction 6, purchase office supplies of $500 on account. So again, analyze, what did the company receive? What did they give up? So they received office supplies. So that's what they received. So office supplies is received. And what did they give up? Well, they didn't give up cash because the transaction is on account. So if you don't pay right away, you owe money. So the company owes money for the office supplies. So the supplies come in and we promise to pay later. So we have a liability and it's an account payable. So we will pay that in the future. So I analyze, we received office supplies. In exchange, we owe for it. And so we have an account with the supplier. We have an account payable. So office supplies is an asset. Just going to abbreviate that. And the account payable is a liability, and I'm just going to abbreviate that AP, account payable. So we have an asset going up, that's a debit. We have a liability going up, liabilities go up with credits. So I'm going to debit office supplies and credit accounts payable. And that transaction was for $500. So we have assets going up, and this is an arrow for liabilities going up. Number 7, paid $900 to lease a truck for 3 months. So we're going to be able to lease a truck for 3 months. So what are we giving up? Well, we paid $900. So we gave up cash. And what we're receiving is a right to use the truck. Right? We get to use this truck. Now, we're not buying the truck, so we don't own the truck, but we have a right to use the truck over the next 3 months. So now we have to kind of think through, what is this when I try to apply it down here to the horizontal model. We don't own the truck, so the trucks isn't something we own as an asset. So this kind of gets us back to this concept, we paid cash, so we have a cost here. In accounting, cost can either be recorded as an asset or an expense. So the question here is, it's an expense if it has been consumed, the cost has been consumed. In this case, we can see we haven't used the truck yet, correct? When we have a, rent or a lease for this truck, but we haven't used it yet. So it's not an expense. It's going to be an asset in this case. Okay, so we know the right to use the truck is going to be an asset because we haven't used that right yet. So let's go down here. When we analyze it, we've got cash going down, and we have another asset. We need to assign some name to it, and I'm just going to call it prepaid rent. We've paid in advance for the rent on the truck. So rent or lease, same sort of thing, right? So we've got cash going out in exchange for this prepaid rent for the truck. They're both assets, so assign the debit and credit. Cash is going down, so that's going to be the credit. Prepaid rent is going up, so that will be the debit. So when I go to the journal, we're going to debit prepaid rent and credit cash, and the debits always go first. So we list the debit first, prepaid rent. And then cash is second as the credit. $900 for this transaction. In number 8, at the end of June, we owed $200 for miscellaneous expense. Now they're telling us it's already an expense. They're not telling us what it was for, but they are telling us that cost was an expense. It's something that had been used, right? Expenses are things that we use in the business. So we don't know what it is, it was just something miscellaneous. So we, in the business, we received or we consumed these miscellaneous expenses. Could have been utilities, that sort of thing, but that's what we received. We received these expenses that we've consumed, and we owe money for it. So some sort of liability, likely, if this is utility, if these are utility expenses that we've consumed utilities, so we've consumed that. And we know retained earnings will go down for that. So retained earnings will go down for that. And what are we giving up? Well, we owe money. So we'll have an account payable. I'm just abbreviating account there. So account payable. So what we received were these miscellaneous expenses that we consumed. In exchange, we owe money. So let's go put these down here. We know that expenses reduce stockholders' equity, and then if we owe money, that's going to increase the liability. I'm just going to abbreviate that AP. So we have an expense causing this side to go down, and we have an account payable causing it to go up. So when we go to assign our debit and credit, this liability goes up with credits, and then expenses reduce this side of the equation. If we reduce that side of the equation, it's a debit. So we're going to debit miscellaneous expense and credit accounts payable when we go to our journal. Whoop, sorry about that. So I list my debit first, miscellaneous expense. That causes retained earnings and or stockholders' equity to go down. That's for $200. And we owe money for it, so that's going to be an account payable. So again, we receive these expenses in exchange for the liability. Then the last transaction issued a $100 dividend to shareholders. So we give up cash. This one's not quite as clear as, what are we receiving? It's really what the dividend represents. So we pay cash out, and in exchange, what we're doing here is we are distributing earnings to the shareholders. So we have a dividend here. And dividends cause retained earnings to go down. So we give up cash as part of the dividend. So let's list these down here. Cash is an asset, and of course dividend is part of retained earnings, and it causes it to go down. So we've got assets going down, stockholders' equity / retained earnings going down. Assign our debits and credits. Assets go down with credits, and stockholders' equity goes down with the debit. So we're going to debit dividends and credit cash. So the last journal entry is to debit dividends, which reduces, I'm going to just put retained earnings here, but you could put stockholders' equity. So reduces retained earnings, or stockholders' equity, does both. And then the credit is to cash. Credits to cash cause assets to go down $100. Okay, then when we're finished with this, then we need to post to our ledger. So let's go take a peek at it. So now we have all of these accounts, and so I'm going to list all the assets here. So assets that we know that we have are cash. We had an account receivable. I'm just going to abbreviate that, REC, because I ran out of space. We also had office supplies. So set up T accounts for all of these. We also had a prepaid rent. And then lawnmowers. And we could have called this equipment, I just didn't, but it would have been fine to have done that. Now remember, debits are always on the left-hand side of an account, and credits are always on the right. Debits on the left. And the debit credit rules are that assets go up with debits. Assets go up with debits. So I've listed all the assets, and I've made a little notation that those go up with debits. Let's list our two liabilities here. We have unearned revenue. That's because we owe services. I'm just going to abbreviate revenue, REV. And then we also had accounts payable. And I'm going to abbreviate it PAY, accounts payable. And we know that liabilities go up with credits. Again, we have debits on the left, credits on the right. Over here, under stockholders' equity, we would have common stock. Goes up with a credit. We would have retained earnings. That also goes up with a credit. And then we had our revenue, which for this company is service revenue from mowing lawns. I'm just going to abbreviate that REV for service revenue. There was a miscellaneous expense. Now, here we got to be careful. Expenses are negatives. So their normal balance is not a credit. It will be a debit. Now, we're going to have some more expense accounts before this whole problem is finished. So I'm going to leave that blank just because I know that's going to be the case. I didn't have room down below. I would have liked to have had one more T account on this side. So I'm going to bring it over here and list the dividends. I'm not listing dividends here because it's a liability. That's not the case. I'm really just listing it because it's part of here. And again, I just didn't have room for it. Okay, so we've listed these accounts, and then I just post. So the first one is a debit to cash and a credit to common stock. So we debit cash, we just copy those over, and credit common stock. So I have a debit and a credit. Second transaction, debit lawnmower, credit cash, $15,000. So I debit the lawnmower, $15,000, and I go to the cash and credit it, $15,000. Again, debits on the left, credits on the right. So I have a debit and a credit. Number 3, debit cash, credit service revenue, $1,000. So number 3, we debit cash, $1,000, credit service revenue, $1,000. Number 4, we debit accounts receivable, credit service revenue, $250. So we debit accounts receivable and credit service revenue, $250. Whoop, went the wrong way. Number 5, we debit cash, credit unearned revenue, $300. So we debit cash and credit unearned revenue, $300. So again, I got a debit and a credit. Number 6, we debit office supplies, credit accounts payable, $500. So we debit office supplies and credit accounts payable, $500. Debit, credit. Number 7, we debit prepaid rent, credit cash, $900. So we debit prepaid rent, credit cash, $900. Debit, credit. Number 8, debit miscellaneous expense, credit accounts payable, $200. So we debit miscellaneous expense, and then for $200, and we credit accounts payable, $200. So debit, credit. And then the last one, we debit dividends and credit cash, $100. So we debit dividends, $100, and credit cash, $100. Okay, so we've posted all 9 transactions, and then the next step would be to arrive at balances. So we draw our line in the T account. Cash goes up with debits and goes down with credits. So I'll take 30,000 plus 1,000 plus 300. So that's 31,300. And I subtract 15,000, subtract 900, subtract 100, and I will get a positive amount of 15,300. So I'm going to do BAL for balance. So my balance right now is $15,300 in my checking account. I take the debits, subtract the credits, and my checking account balance is $15,300. Accounts receivable, office supplies, prepaid rent, and lawnmowers, those are their balances because we only had one event in there. Unearned revenue is its balance. Accounts payable, I add those 2 up, and I have a balance right now of $700. Common stock, there's nothing in retained earnings. Service revenue actually is $1,250 of a balance. Okay? And then I'm going to take these numbers, like the 15,300, and we're going to go put them in a trial balance. So I just want to be clear. I'm going to take this 15,300 and I'm going to put that balance on the next sheet as a balance for cash. $250 will be the balance for accounts receivable, $500 for office supplies, $900 for prepaid rent, $15,000 for lawnmower, and those will all be debit balances. Then when we get to the liabilities, these balances will be credits, likewise with common stock and service revenue. And then miscellaneous expense and dividends will have these debit balances. So I'm just going to take those and I'm just going to plug them in and I'll show you the end result. Okay, so we can see now that I've entered in the balances for each of these. Starting with cash, I took that debit amount and put it here, and accounts receivable, prepaid rent, listed all of those as debits. The liabilities, the liabilities listed as credits. I went ahead and put the dividend in, and then service revenue is a credit and miscellaneous expense. Then I added the debit column. I got $32,250, and I added the credit column and got $32,250, so I'm in balance. And if I'm in balance here, if my debits equal my credits, I breathe a sigh of relief. Whew, everything is fine. Okay, so hang on a second. Okay, so this is really the end of part one of this particular problem.